You're watching The Open on BNN Bloomberg. I'm John Ehrlichman sitting in today. What comes next? It's the big question for investors after a record run-up for stocks. For some more insight and analysis from the trading floor perspective, Diana Avigdor joining us now, portfolio manager and head of trading at Barometer Capital Management. Diana, it's always great to see you. It's been such an eventful summer. And at the end of the day, beyond all the headlines, all the earnings, all the geopolitical stories, all the questions about the economy, stocks in Canada and the U.S. are sitting around all-time highs. What's it been like from your vantage point?
It has been incredible. You wouldn't have thought a year ago that this was going to happen. Thanks for having me, John. It's a pleasure. Market's doing well. Internal indicators are good. Economic data is not bad. I mean, we have a hot number, a soft number, but overall it's okay. Investment grade spreads haven't been this tight in over a decade, really. So balance sheets are good. Earnings are growing. Not bad. We're going into a seasonally quiet end of month, August, and a seasonally fearful September. But yesterday, the volume on the New York Stock Exchange was the lowest since May. So we're going into a quiet end of August, and earnings season is done, more or less in the U.S. We're still waiting for the banks in Canada, and we had a decent CPI number this morning. So things are okay.
Yeah, a lot there. So I guess if people are trying, we always talk about these catalysts. Should we watch this or that? And you're more familiar with the rhythms of the market than anybody. Is that how you approach the next few weeks? You're watching to see sort of how the market dances around, Powell commentary or something else, or is there something really that investors should ask themselves that is a little bit deeper than that?
Well, I've highlighted to you some of the most important things. Earnings is what's the most important thing long term as you look at the trajectory of growth there. Macroeconomic data is the other thing that investors should be watchful for. But what we've done, and we discussed this a couple of weeks ago on air here, we've raised a little bit of cash just to take advantage of any potential opportunities that may arise out of a seasonally treacherous month coming up. We have rallied quite a lot since April lows. And in the absence of, bigger volumes and other data points, we do have, short-term traders, option details. There's a large option trade that's coming due in mid-September that the market's watching for. So I think that we've taken out a little bit of the volatility out of the portfolio just to be able to manage the volatility and the risk. So we've raised a little bit of cash into this, but not substantial, not in any meaningful way, maybe about 5 to 7%.
I'm also just looking at the TSX itself, and, we had kind of like an 8%, 18%, and now so far in this year, 13% advance. Sometimes just sort of the outside observation, you don't necessarily feel that way. We're always worried about what's happening with the Canadian economy. We're always talking about the Magnificent Seven and the S&P 500, but, I think a lot of people would take that kind of performance over a 3-year stretch. Now, I guess we'll see if this year's gains hold, and I know a portion of this year's gains are tied to the rally in gold. But what do you make of what's been happening with the Canadian market specifically?
Well, clients are concerned about the same kinds of things: tariffs, impacts, inflation, recession, public versus private investment, Canada versus U.S. Canada falls into, you step back and you look at it globally, it falls into the international portion of people's portfolios by and large, not ours domestically, but globally. If I was to bottom line what clients are doing, they're interested in diversification and risk management. And Canada falls into that, trading at 52-week highs, and Europe as well. I think that continues to attract flows. I think that we're going to possibly see that in the bank earnings. We've seen that in the TMX volumes on the stock exchange, our own stock exchange. So I think that continues to be a theme for Canada.
Yeah, we do have those bank earnings coming up. What would be the things you'd be looking for from the bank CEOs to get a sense on how they feel about the economy? Because you were referencing the inflation print for Canada this morning, probably soft enough to justify if ultimately the Bank of Canada felt they had to cut interest rates. But I'm not sure everybody is convinced they're going to cut interest rates. But to your earlier point, like we've kind of shifted off of the trade story, despite the fact that there still seems to be like lingering trade challenges for Canada's economy. So what are you going to be listening to from some of those banks?
Truly, I think that what's happened with Canada over the last year, or at least since President Trump kickstarted this issue, is that, we started looking at our own efficiencies. And, what's possible is that we're kickstarting private sector investment that would reverse nearly 10 years of stagnation. So Canadian bank stocks, and what we're going to be hearing from the Carney administration as it relates to any kind of dealings with the U.S. Remember, our tariffs are mainly protected under USMCA until next year, so there's a small portion. We're really looking forward. So from the banks, just going back to your question, what we're watching for the banks, they have significant excess capital. And they could be delivering some healthy returns. I mentioned the TMX and TMX volumes. They've gone up about 36% year over year, and on the option side as well. So, if we have improved policy visibility and lower rates, it could set the stage for positive EPS revisions. And with the economy chugging along with decent employment, we've gained about 40,000 jobs in the last two employment prints. So lower than expected PCLs could be a driver for the banks here. And capital formation.
Well, like I keep saying this, and you're in the weeds every day. Maybe this is not the case, but just in 25 years of covering this stuff, I think it's very interesting that we have the day-to-day story, and then we have these trend stories. We have like decade-long themes that are very much alive in the market, probably because we're all sitting here wondering where the world's going to be in a decade. So you've got the AI trade. Now you mentioned the infrastructure trade. The other interesting one has been defense. We've talked a lot about it. You guys at Barometer have been tracking it closely. It was interesting, as you saw, some of the European defense stocks were softer today just because, conceptually, if we're seeing a push for peace, which I think we all want to see, it takes a little bit of a leg out of what had been a hot sector. But how do you navigate that? The fact that these companies are going to move on headlines, but their businesses are actually being built over the next, 10 to 20 years in terms of these thematic themes.
If President Trump has his way, everybody will be more independent and spend more on defense. Defense companies around the world are all going to benefit. Locally on the international markets, let's talk about Europe, for example. Germany already announced increased defense spending, and that's going to happen across the board. But they also buy American weapons. Yesterday was a headline out of U.S. and Ukraine, and how Ukraine was going to buy $100 billion worth of American weapons. So it's really the world rearming at a time when we're looking right now that peace is going to break out. So for today, it's a little weaker. But the big trend is just more defense spending that will kind of pay into the coffers of all of these defense companies globally.
Okay, and then just a final question for you on gold. I was having a conversation with one of our longtime guests, Ross Healy, earlier. He doesn't like where some tech valuations are right now. He's iffy on the likes of NVIDIA after the run-up that they've had, and that he had made a pretty calculated bet on gold. Gold, as I referenced earlier, has been one of the drivers for the TSX this year. We've talked with you about sort of your current stance on bullion. After the run-up that we've seen, What is your general gut sense on how gold will be how it will fit into the market theme, how it will be used by investors and traders going forward?
So gold has been one of the, I think, the second best performing asset class year to date, right behind Bitcoin, which is probably the same kind of theme, protection of capital, protection against inflation. The thing with gold is that gold doesn't really get consumed. The price has to do with, the marginal buyer and the exposure out there. And I'm stepping back from just Canada, but just globally, reading reports of exposures globally. Investors don't have all that much gold in their portfolios yet. I think I read something about 2 to 3%. Sure, Canadian asset managers have more, but there's a lot more dollars that could potentially come into this sector, and also for the higher risk appetite into Bitcoin for the same reason. So I think that it becomes a more constant exposure in portfolios that kind of stays around for a little bit while longer, even if the price kind of fluctuates back and forth. As things get better, as inflation comes down, it might come down a little bit, but I think that it becomes a little bit more constant going forward.
Well, listen, we're on a roll, so I'll throw one more at you here, because, I wonder, a lot of people have said, hey, look, gold is up and tech stocks are up. How can it be? But I wonder if that theme of, if interest rates can come down, do people in part look at gold for that reason? But do they also potentially look at tech stocks, which Bitcoin still sort of trades like a tech stock? If you're a believer that we're not going to see a surge in rates or that they can come down, is there a case to be made for both gold and some of these tech names continuing to find buying interest?
So I think the differential in your question comes down to short-term versus long-term. So so do we agree that rates, even if they come down, let's say you believe that, the Fed is finally going to embark on a second leg of rate cutting and so forth, we're not going back to where we were 5 years ago, correct? We're not going back to those zero rates or when we were calculating how many trillions of dollars globally were trading at negative rate territory. That's not coming back.
Right.
So, they're going to come down, and then, it's going to be a cycle of economic data and so forth. So that actually supports a constant allocation to gold. But as rates come down, the economy is doing well. These tech stocks are where you have a huge amount of growth. And I believe that there's always going to be investors that will pay up for growth. And especially in an inflationary environment, it's also a hedge for inflation when you buy into stocks that have this kind of growth. Where else are you going to put your money if there is inflation?
Great conversation.
So both can work.
I know, Diana. No, it was great. Really appreciate you fielding all of those questions. Always a pleasure. Thanks for your time. We'll let you get back to it.
My pleasure.
Diana Avigdor joining us, portfolio manager and head of trading at Barometer Capital Management.